Good afternoon, everyone. I'm Bagadon at Stock Market Caddy, and today is July 7th. July 7th at about almost 3 p.m. I'm making this video with our members in mind, our annual members as well as our monthly members, but I'm also going to, as an informational video, post this on YouTube as well. I wanted to share with you what we did yesterday and where we are today on Goog. Goog is currently trading at 23.88. 23.88. Yesterday, we put together a vertical call spread. We bought a call at 2260, nearly 130 some odd points ago, right? It was much lower. Actually, Google was trading at about 2250. And we bought that call for 22 days, and it cost us so much money. I'm going to show you in a moment. To offset that debit, we sold a call higher, 23.25, also for 22 days, and we received a credit, which reduced our overall cost of the vertical spread. This is the vertical spread today, 22 days. Its open P&L is just $20. The trade cost was $3,280. The maximum loss was $3,280, the cost. The max profit is $3,220. Okay, that's the max. Now, what I want to do is to break this apart. And I'm going to come here at TradeStation, and I'm going to push a button called Reset. And we're going to examine exactly what we did, what the costs were, what the credits were, where we are, and where we stand to gain. The call, the 2260, cost $11,070. Our maximum loss is $11,070. Our max profit on this is infinity. So, as Google, in this instance, and we took this trade, by the way, off of what we call the SMC Trade Generator, Pebble Beach Triggers, which is a fantastic tool. As Google continues to run up, this call is going to continue to run up in value. And if I wanted to go and sell to close this call option, it would be worth not $11,000, but $18,450 some odd dollars. But we also attached a call that we sold, a short call, at 23.25. So let's examine what we've done here and where we are, also for 22 days. Now, in this instance, at 23.25, in this instance, we sold the call, which we received a credit of $7,790. Now, that is in our max profit. Our max profit is $7,790. And our maximum loss, if it was alone, would be infinity. And over here, our max profit would be infinity. But that isn't the case when you do them together. So let me just show you. I put this on top, and it recognizes it as a vertical call spread. And what it does is it puts the debit and the credit together to show us now our true trade cost of $32.80. And then also our max profit. So let's break it apart again and let's just discuss what's taking place. As Google runs up, this runs up in profit. But the call that is short is going down. Why? Because we're in essence short, and in order to close out this contract, I'd have to spend not $7,790, but some $14,000 to close it. You see what's happening here, and I'll try to draw this out. Bear with me. So to draw this out, when we bought Google at $22.60, we were placing a bet that Google was in fact going to go to the moon. And let's put that little marker right here. Excuse me. Let me just draw this out. Bear with me. Put a little marker here. That was this one, $22.60. This is the one that for 22 days, and it cost us $11,000. Now, Google has earnings on the 26th. There's plenty of reason maybe for it to go to the moon, but we didn't think that it necessarily would go to, go up 1,000 points from here. So why not? If we bought the call, and the risk, of course, was that it didn't go up, that it went down during this time frame, and we would have at risk this amount of money. So what we did was, okay, not to get too greedy, we say we will come up here at 23.25. We'll call it right here. And what we will do is we will sell somebody the right to call the profits away from us above 23.25 during these 22 days. So we're not going to profit. If Google runs along here and continues to run up, this call option, the original one, is going to continue to show this profit, which is what it's showing here. But this one is going to go down. And that's where it's hedged. Our profits are cut off at this point. We can only profit between from 22.60 to 20, and let's do the math. Bear with me. Between 23.25 minus 22.60 is $6,500. $6,500. So if at expiration we're at this point or higher, we will profit $6,500. But you say, well, wait a minute, Bagger, you paid $11,000. Yes, we did. But we also receive, let me just do the math here, $6,500 plus we get to keep the premium of $77.90. $77.90 is $14,290. So if Google is above this marker, we'll get to keep the profit. We'll have a total profit of $14,290, but we paid out $11,000. So we got to subtract 11,000, and it is approximately 3,000, give or take. 3,220 would be our net. Therefore, let's just lose our little drawing tool for a moment, and let's take this and put it back on top. There it is. Our max profit, 3,220. So that's where we are. So I'm going to break it apart. Why would I do that? Well, it's always with hindsight, right? I could have just bought the call, and I could have paid $11,000. A couple of days later, thanks to the Pebble Beach trade generator, I'd have $7,300 in my pocket. That'd be sweet. But what if the price didn't run up here as it's done? What if it had run down 140 some odd points? The call option that I bought at $22.60 would be down about $7,360. That would have hurt. But this option that we sold, had the price run down, would it be up or down? It would be up about $7,490. It would have insulated me from that hedge. So the way I handle this is this. On the credit side, if I have the opportunity to close and collect at least 80 or 90% of this credit, I'm going to close it. But that's not what I have here. I don't have that. Had the price run down that much, I could have closed it. And what would have been neat was I could have kept all that money, and then if the price just ran back to even and did it real quickly, could have made quite a bit, could have turned around and done something again, could have done something further. In this instance, though, I don't want to close that and lose. I would be losing $7,000 and then have the price come back, and then I could really get hurt. So I don't want to close it. What I want to do is simply put the two of them together, understanding exactly what I did and why. Maybe you would have structured it differently. Maybe it wasn't the best structure, which is we can always learn. But what I need to do in my mind is I just need to wait a little. This is only a couple of days old. This other leg, this one, as time goes by, it is going to become time. Let me put it this way. Time is on our side on this one. The more time that goes by, the more this credit will accrue to us. So we have right now, we got the direction right. We've got a very handsome run, and we just want to now just sit tight. I don't want to panic and destroy the structure of this trade, because we'll have ample opportunity to see that other side, that credit accrued to us, and I think we got a really good chance of making, a few grand, and we still got, ourselves pretty well hedged. I hope that makes sense. Feel free, if you're a member, annual member, monthly member, and you want to chat about this type of setup, where it came from, and how and why we did it. Now, we also did one over here, and the biggest thing with options, I think you just need to be patient. What we're doing with futures intraday is much more active. Here, we want to be patient. Let's look at what we did yesterday with gold, and we'll tee up gold. Gold is trading at 162.26, just about where it was yesterday. It's up a little bit. We sold, excuse me, we bought 10 call options at 160, betting that it would go up. We paid $4,850, our maximum loss. Our max profit is on that one leg is infinity. If it was just the one leg for that length of time, over 29 days. But we didn't do it in isolation. We also went up and sold to reduce and hedge our risk and to reduce our cost. We sold 10 August 5 calls at 170. Also 29 days. The total credit that we received was 960. That's the most we can receive. Our maximum loss, had we done this in isolation, selling a call is a short position and our maximum loss is infinity, and our max profit would only be 960. But that isn't what we did. And that isn't what we have. In fact, TradeStation recognizes what we have. I'm going to click on this, and when I drop them on the 2, TradeStation says, aha, I see what you did. You have a vertical call spread, 10, August 5. You bought 10 160 calls. You sold 170 calls for 29 days. And you spent a total of $3,980. That's our max. That was our maximum cost. That was our trade cost, and that is our maximum loss. We don't have an infinity. Our risk is defined. $3,890. And in this instance, our max profit is $6,110. A much greater risk reward. I like this trade better than this one, but this one's should work out just fine. The biggest thing we need to do is just to relax and let them play out. With options, it takes time, but you want to understand what it is you're doing, why you're doing what you're doing, and not get emotional and start trying to close out the various legs. Because if you start doing that, in our view, you destroy the very trade, which is a very good trade, before it has a chance to breathe and to bring the profits to you. So we just want to relax. Our risk is defined. In both instances, we are long gold with a hedge and long Google with a hedge. We have plenty of time, and time is on our side. Both trades are just fine. I'm Baggett on StockMarketCaddy.com. This is just one aspect of what it is we do. Members, annual members, monthly members, got any questions on what we just described? And I'm also all ears. Maybe you would have done it a little bit differently. And we will, during the summer months, be trying to demonstrate some of the other options. This wasn't the only way to have expressed a long view in Goog or in gold. In both instances, we used tools from Stock Market Caddy and yes, TradeStation, namely though the SMC trade generator. Pebble Beach is how we got the Goog trade, which is doing great, and we used Swing Machine when they were panic selling gold yesterday, which is exactly when we want to be buying. Good luck, everybody. Call with any questions. I'm Baggett on 813-758-8263. Thanks. The reason, and in closing, the reason why we don't want to close this other leg on Goog is this. How do we realize, we put them back together again, which is kind of cool. How do we realize the 3220? What has to happen for us to get our P&L to 3220? Well, more time has to go by. We got to get down. If we had just one day to go and Google is trading at 23.92, above 23.25. That's all we have to do. If Google is above 23.25, and it already is, and we just got one day to go, we're going to realize 32.20. Right, so that's where we need to know. We've done what we need to do. Now we need to be patient. If we were to come in and not understand and panic and begin to close this, we change the whole dynamics and put, it just wouldn't be the thing to do. And we would change all the risk parameters. Okay. Now, if after 10 days, 15 days, we start to lose and lose more time, or time begins to decay, and our profit gets up to $2,100, $2,500, and you still got another week, 7 or 8 days to go on the option, and you've got 70 to 80% of the maximum profit, and you want to come in here and close the entire position, you would want to do that. Your brokerages are not going to let you, unless you've signed the appropriate paperwork, they wouldn't let you close this one anyways, leaving a naked call option out there if you hadn't signed off on paperwork understanding what you were doing. And that would not be the thing to do, and that isn't what we're going to do. Good luck, everybody. We're happy to chat with you. We will be doing also in the weeks ahead, buying shares and writing covered calls. And it just takes time for them to play out. Thanks.